right, so without further ado, I'd like to turn it over to our presenters today. We have Steve Volley, who's our Senior VP of Real Estate. Sorry, it's not senior, is it? VP of Real Estate. He's senior to me. And then John Stolas, who's here with us as well, who's a real estate agent from United Real Estate. Yes, okay, great. So without further ado, I will turn it over to Steve.
Thanks, Josh. Am I good, Kyle? Welcome to everybody that's streaming as well as the folks here today. This is not going to be a how to buy a home seminar today because there's just not enough time, an hour to go through all of this. What we're hopefully going to cover is some of the basics that folks, when they contact us, go through and they have the most common questions about. So what I'm going to hopefully help do for you today is develop a path to home ownership through some of the landmines that our home buyers face in San Diego and Riverside counties. So for those at home, you see our presentation. So forgive me, this is the first time I've done a streaming event where I don't see all the audience. But what we're gonna work with then is CalCoast has a new program called through HomeSmart Realty, and it's a home buying service that our members can take advantage of, and it provides a tremendous level of service and some discounts that we'll talk about later on with respect to buying or selling a home. So in addition to going through some of the basics about financing, we're also going to cover some information with respect to realtor services. Okay? And John will speak briefly to that when we get to that point. So if we go to the topics of discussion, we're going to talk, these are the key things that we deal with on a day-to-day basis. And by the way, if you get a loan through CalCoast, all the processing is done out of this office here at the Spectrum Boulevard office. This is the main office. You have an option with our different channels. You can go, if you want to deal with somebody face-to-face, you can go to the branch, talk to our PFRs there, and they'll be happy to take an application. If you're fortunate enough to be one of our preferred partners, we do have our business development people calling on businesses. And Karen Burke-Acosta here today, she does a lot of that, where they'll take applications at a place of business. We also have a call center where they will guide you through an application process as well. And last but not least, if you feel so inclined, you can do it online and walk through the various steps through the website. All channels get to this office. It's just a matter of who you go through to get to the processing staff. So today, very briefly, we're going to talk a little bit about credit and credit scores. We're going to talk a little bit about what it takes to qualify for a mortgage. And then finally, we're going to talk about our home buying service and why that may be relevant to folks buying in San Diego. Okay, so without much further ado, we'll talk about credit. Why is credit so important? Well, unlike going and buying gas where you just basically shop for the price per gallon, getting a mortgage, there's a lot involved with that. And one of the key components to that is your credit score. And obviously, the higher the credit score, the better your rate. So unlike buying gasoline, you just don't drive around to where you get the lowest price. You want to, that's the only determinant. If you have great credit, you'll get the best rates at any lender. So one of the key things that we look at CalCoast is we want to make sure you have a FICO score of at least 620 or higher. And there's a number of things that go into your credit score. The number of accounts you have open, balances to limits, late payments, delinquencies, foreclosure or bankruptcies. Those all affect your credit score. Yes, sir. Okay, so the question pertains to the number of accounts. The more, the better? Necessarily. And so I appreciate the question. So a good example is if you have one account and you have a limit of $10,000 and you have $8,000 charged against that, versus 3 accounts that have $10,000 that say each have $3,000 on it, your credit to available credit is higher with that one account than possibly 3. So in some respects, having 3 accounts with lower balances through a multitude of lenders may actually score better, because one of the determinants that goes into your FICO score is balance to available credit. Okay, and I don't speak for the credit bureaus. They've created this. These are the standards that we work with. The other thing that comes into play when you go to get a real estate loan, whether it's CalCoast or any other lender, we're going to pull credit reports or credit bureaus from all 3, Equifax, Experian, and TransUnion. Okay, I think that's right. And we typically throw out the high and the low, and we take the middle. So if you're buying with another person, we're going to take the lower middle of the 2 of you. And why that's important is that may limit you on the products that you qualify for, as well as the pricing that you may obtain based on your credit score. If you have a credit score of 720 or higher, you're typically in the best tier for pricing. So one thing that you want to look at, if you're calling around town and you want to know what everybody's rates are, first of all, credit score is going to be a huge determinant, and we'll go into some of the other variables associated with that. So anybody here have any other questions with respect to credit? Yes, ma'am. Yes and no. I'm sorry, the question again was, if you have a balance of, back to the original example, if we have a balance of 10 or credit limit of 10,000 and you have a balance of 8,000 every month that you pay off regularly, that's going to factor as a satisfactory payment history. I don't think that that would adversely affect you as far as that goes. But to your point, I can't specifically say that that's going to raise your score. If you have one account and it's paid very well, that should not adversely affect you at all. Okay. I'm sorry, 720. The credit, to repeat my comment, if you have a credit score of 720 and higher, you'll qualify for most of the programs that we have here. We have some unique programs at CalCoast that we require a high credit score because we're not requiring a down payment or some other features. But that'll be, we can go through that a little bit further. One of the components of pricing a loan is your credit score. And that's what we look at. You may have great payment history. You may pay all your bills on time. And you have a 680 FICO score. Well, our pricing will be determined based on that score. So, okay. Any other questions on credit? If you can skip ahead 2 slides, I'm going to jump to one more, types of income. Now, the next thing we look at, as with most lenders, is we look at your income. And when we look at income, we're not talking about what you take home. We're talking about what's in your gross paycheck before all that taxes and everything, insurance, whatnot comes out of it. So when we look at income, we're going to look, if you're a W-2 employee, we're going to look at your gross. We're going to look at the bigger number associated with your W-2 or your pay stub. And if you're hourly, we'll factor that out and look at a historical for you over 2 years to make sure. If you had a raise, we're going to take the higher amount, but we're just going to make sure that your hourly is consistent with what, it's not just 1 month. Or if you work a lot of overtime, we're going to look and make sure that you have a 2-year history. If you're self-employed, we're going to look at your historical returns, and we're going to see that you have several years of making the money that you're making with respect to self-employment. Did you have a question?
Question on the prior history. So for the 2-year example, let's say you're switching jobs and you take 6 months off and not traveling.
Okay. Okay. The question is, what about if you change employers and you have a gap in your employment? Okay, and for this example, it's 6 months. The gap is not as important. The change in job is another. So let's say you went from a salaried W-2 job or an hourly W-2 job to self-employed, that in all regards we would need to have a 2-year history to continue. You would have to be working self-employed for 2 years. But if you are a salaried W-2 employee, or hourly, I'm sorry, a W-2 employee, if you take a break, and let's say you start with one company and then you take a break and you come back to the same industry making the same or more, we would just have to explain that break, that pause, and then document it going forward, okay? If you're a college student that has just graduated, we would look at education as a component of your 2 years history as well. So that works out. So let's say you graduated from college and you're now working for 8 or 9 months. We will, if you're a W-2 employee, we would consider the education a 2-year history. Okay. Any other questions on that? Okay. So then if we take into account your income and self-employed, rental income, I won't go into those specifically, but those are all variables that go into it. If you can go back a slide, Kyle. What we're looking at, as with most lenders, is we're basically saying we're going to take 43% of your gross pay, and that's what we can qualify you for all your debt payments after you buy the house. So for example, if you have a car loan and it's $250, we're going to factor in that to your total 43%. So that's $250 that can't go to your house payment. So for example, if you make $5,000 a month, $60,000 a year, that dollar amount that you can spend for all debt would be roughly $2,150. And that's basically 43% of $5,000. And I'll give you an example of that when we get closer. And when we factor that in, we're taking into account your principal and interest. That's actually the cost of the money that you're borrowing. So that would be a factor of the interest rate, the term or duration of the loan, and then equating to a monthly payment. The taxes that you would pay on the property. And unfortunately, everybody pays property tax when you buy a house. And depending on where you live, that could be anywhere from 1% to 1.8% of the purchase price of the property. And then we divide that by 12. And then we're also taking into account your insurance. So much like if you own a car, you have to have insurance to protect the value of the vehicle, or more importantly, the actual asset from fire or theft. We would require that as well. For folks that look to buy a condominium, we would factor in that HOA fee. The other variable that comes into play is if you have less than 20% down on many of our loans, we're going to require mortgage insurance, which we'll discuss briefly as well, but that would also factor into it. So one of the key things I tell folks is if you're looking to buy a house this year, don't buy a car, because that will eat up a lot of your ability to spend, and it will factor in. I will guarantee you after you own a house, you'll be able to buy the car. I shouldn't guarantee that, but it'll be easier to buy a car if you own a house after the fact than the other way around, because the qualifications are much less. And you've heard getting a home loan is very difficult. I'm happy to say that here at CalCoast, we still require pay stubs, W-2s, and supporting documentation such as bank statements, but we're not to the point of asking for blood or urine, and that's going to be a positive as long as I'm here. So anyway, that 43% is kind of a hard and fast number. Yes, you can go higher, but generally most people work into that. So if you're paying rent and you're spending more than 43% of your current gross income on your monthly rent payment, you are already exceeding what we can qualify you for a home loan. So keep that in mind. In some cases, renting may actually be a cheaper option to buying. Although with the way rents are going and the tight market, that may not be the case. Okay, so then let's go into a scenario with respect to an option that we have at CalCoast Credit Union, a shameless plug for our 100% financing program. We have a loan that will allow you to buy up to $484,350 with no down payment. It doesn't mean that you don't have to have any money to close for closing costs and whatnot. It just means that to qualify for the loan part, we're not asking you to put any money down. So in the scenario that we have here, and I believe the interest rate was right around 4%, you would look at the principal and interest payment. And in this case, it would be $2347.40. The taxes calculated on a purchase price of $484,350 is approximately $443. Multiply that by 12, that's what the annual taxes would be. And in this case, the homeowner's insurance is $70 a month. In this example, this is a single family house. There's no HOA associated with it. So in this example, the total monthly payment, qualifying payment that we referred to previously as the PITI would be $2861.39. So now if you go to the next page, and for those at home, I believe that's page 8, I tried to back in to see what people would qualify or what income they would need to qualify with some standard debts. So in this scenario, I assumed a car payment, and with the cost of cars nowadays, if you have a $250 payment, that's a pretty good payment. But I'm estimating on this, say $340 for the example. And that's the minimum payment that would show up on a credit report. As in any of these debts that we're calculating towards your qualifying, we're looking at what would show up on a credit report. We're not referring to a cell phone bill. I don't believe they're reporting on credit reports yet. And utilities. So we don't even factor in what you'd have to pay for water and electricity in this number. But for example, this would be a credit card minimum monthly payment of $100. And remind everybody, I always ask folks, so what do you have in the way of credit card debt? And they'll tell me $6,000 or $4,000 or combined $8,000. And I say, okay, but what I need to know is what your payment is. Then they'll tell me, well, I pay $200 a month. And I say, okay, but what does your statement say is your minimum monthly payment? So for this example, and for qualifying, it's the minimum monthly payment you're required to pay. So in this example, the minimum monthly payment, I think I assumed they had one credit card, probably has a balance of maybe $2,000 or $3,000, and it's $100. So in this scenario, I'm taking into account the car payment, the credit card payment, and the new PITI. And therefore, the total payments that I'm counting as the total debt against the borrower is $3,301.39. And in this scenario, the household income was $92,000. Their ratio came to 43%. Can you see how having any debt works against your ability to qualify for a higher payment? So that's why I emphasized before, if you're going to buy a car, a new car, and have to finance it, don't buy it before you buy a house, because that will really cut into that. Does that discourage people or encourage people when you see those numbers? Does that make sense? Sure.
Hi, Steve. I had a question from the webinar that's relevant to this slide. So how would student loans factor into this?
Oh, great question. And of course, you threw that in. It's got to be somebody from my department that called in, I'm sure. So we look at, and I'm assuming they're thinking it's deferred. And so what we would look at is the minimum monthly payment associated with that debt. Deferral does not preclude you from paying that. We typically will reach out to the borrower and have them get something in writing as to the minimum payment associated with that debt obligation. And that would be factored in as well in this. So many times on a credit report, it'll show a balance, but it won't show a minimum payment. So we have to do a little extra research to verify what that is. Hopefully that answers the question. Correct. A student loan would be viewed similarly to a credit card or a auto loan. Correct. The only difference is when you look at folks that are actually in school or just graduated, or they may be working and they're going to class, getting a master's or continuing ed, or they're getting their undergraduate degree while they're working. The student loan on a credit report does not typically report a payment. So we have to go and get additional information on that with respect to the agency or the lender that has provided that. Hopefully that answers that question. So, you know, you see it all the time on TV that student debt is reaching historic proportions, and that's the biggest burden that's going to affect folks' ability to buy a house going forward. That is a debt that we would have to factor in here, unfortunately. Okay, any questions on how we calculated it? Yes, sir. Sure. Yes. I appreciate the question. The question was with respect to our example that we put up on page 7, if you're following via live stream. On our 100% financing program through CalCoast, we have no mortgage insurance. This is just one feature that we have with a zero down program. We do not require mortgage insurance. And so I'll anticipate the questions that will come. In the mortgage arena, if you have less than 20% down, you typically are looking at having to pay some form of mortgage insurance. And while people like to badmouth mortgage insurance as an unnecessary fee, whenever the mortgage gods started lending, they said you had to have a certain amount of down payment for lenders to lend to you. And lo and behold, they came down that 20% was a number that they were comfortable with. Well, prior to FHA or VA loans, if you didn't have 20% down, you couldn't buy a house. So private mortgage insurance basically is insurance that will allow a lender to lend you money when you don't have 20% down. So in this scenario, there isn't any mortgage insurance. For other products that we have, there will be mortgage insurance. This has a loan limitation, so this won't fit everybody's needs. But think of mortgage insurance as not necessarily a necessary evil. It allows you to buy with less money down. All you're basically doing is buying insurance, if you think of it that way, for the lender in exchange for, if you put 3% down, in effect, you're buying 17% insurance for the lender. So between the down payment and the insurance, you have 20%. It doesn't work exactly like that, but that's the theory behind it. It's basically insuring us, the lender, against default if you have less than 20% down payment. Anybody have any question, follow up? So we have a whole list of loans. We offer a full variety of that. Because this is a home buying seminar, we emphasize that, and I'll take that as a segue. Getting into a home loan or in a house is not the same as buying a car. Unfortunately, the only variable that you get when you buy a car, and hopefully everybody has bought a car and they've financed it, the only difference in the home loans that we offer you is you're still getting a rate based on maybe the year of the car, and then your credit is based on your interest rate is based on your credit scoring. And then the only other variable is the duration of the loan. So you might have a 60-month, you might have a 72-month, a 6-year, 5-year, 7-year, depending on the vehicle. But then the rate is set and those are all fixed. Unfortunately, when you buy a house, not only are there a lot of variables that go into the homes that you buy or the condos or the uniquenesses of the property, but we have a variety of loan options that can confound your buying process. So we have traditional 30-year fixed where the rates stay the same for the whole duration of the loan. We have also adjustable rate loans, and those have benefits that allow you to maybe afford a little bit more money up front in exchange for a possibility of your interest rate changing. I think we present to the market very conservative adjustable rate loans relative to the ones that were offered in 2006, 7, and 8 that caused a lot of the problems. So the stigma with the adjustable rates that were out there, most of those loans have disappeared. These are more our traditional adjustable rate loans, but we offer a wide variety. When we go to when we go out to our membership, we're trying to provide a wide variety of loans. One of them is we've identified, and we actually have approval from our regulator to actually go up to $484,000 purchase price with no down. So we've actually received a waiver because we do a very good job of lending money, and we have a very good track record for low or no default. Any other questions on that? Yep.
That 484,000, is that the cap for that mortgage option?
So for the question is the $484,350, is that the cap for this program? Yes, it is. It's a special carve out that we've created, and that 484,350 is a number which is the conforming loan limit for San Diego County. As the loan amounts go up, that will go up as time. Unfortunately, that doesn't go up as quickly as the cost of housing, but that is that previously to this year, that was 350,000. So it's a very good program if you can find housing within those numbers. All right. Right. Yeah. So to Karen's point, it's a means to get you in, and I would argue, my recommendation is if you can get in, try and get in. It's an investment as well as a place to live. Many people look at buying a home as a means of stabilizing their housing costs. I don't know how many people had their landlord come back to them and say, hey, this year we're lowering your rent $200. It doesn't happen. So in that regard, if you can get into a mortgage that helps stabilize your payment, and then you also have an investment, and over time in San Diego, historically, your value has appreciated. So what most people do is they buy their first home, their starter home, build equity, they stay in it for a while, and then they use the equity when they sell to buy up. All right, any other questions on that? All right, so we covered the zero down. Now I'd like to talk about our exciting program with respect to home buying. Does anybody know how realtors get paid on a purchase transaction? Well, the realtor doesn't get paid by the home buyer. They get paid by the home seller. Generally, if I'm going to buy a house, I will enlist the services of a qualified realtor who will list my house. Generally, they'll put it on the MLS listing service, and they will charge a listing fee of whatever is negotiated. It's usually around 3%. And then as part of the listing agreement, and John, correct me if I'm wrong, the listing agreement says that they will pay a buyer's agent 3% for bringing a qualified borrower to buy the house. So as a home buyer, your fee is for a realtor is typically paid in the purchase transaction by the seller. So I showed you the example of no closing costs, or sorry, no down payment. But in an example where you have no down payment, you still have transaction costs associated with buying the house, title, escrow, and then in many cases, we're going to have you prepay taxes and insurance so that going forward, you have the amount on hand to pay that. Well, in a typical transaction, and this is the same example, and this is on page, forgive me, we've jumped ahead to, sorry, for those at home, it's on page 9. So here's a typical example of buying in San Diego. Don't hold me to the exact numbers. It could be lower, it could be higher. I'm just trying to emphasize the need for cash when you go to buy a house with zero down. In this scenario, even though you're not required to put a down payment, you're still going to need $8,200 to close. So in this scenario, title, escrow, loan origination fees, which are a component of the loan that you select, I'm just going to give you just a big number. So that's roughly $5,300. And then prepaids, those would be paying up your insurance so that when your bill comes due a year from now with the number of payments that you're going to make, you have enough to pay your taxes and insurance, which are usually incorporated into the monthly payment. So the value of having a home buying service that we have structured here at Cal Coast is we've actually are giving you something back when you use one of our preferred realtors. And that is, we offer, the program allows you a 20% rebate on a purchase on the agent's commission. So if you can, I don't know if I have a page on that. Simply put, if you're looking at in the handout, if you're looking at a scenario, if you bought a $500,000 home and the agent's commission is 3%, that would be $1,500. I'm sorry, $15,000. Thanks, John. And as a member in this program, you would get a rebate of $3,000 that you can put to closing costs. So right away you see, wow, if I have about $8,000 in closing costs, this program helps offset that cost. And consider maybe you get the seller to pay some of your other closing costs as part of your negotiation with one of our top-notch realtors, if the market allows. You could actually get that down. But this program basically helps you locate a house, work with a qualified realtor, and get a rebate and money towards your closing costs, which is a huge benefit that we provide for our members. Anybody have any questions on that? Agents, commissions? Yes, ma'am. Okay, great question. So the first question is, what part of closing costs are typically paid for by the seller versus the buyer? In this example, I've estimated only the buyer's costs. I'll defer to John if I get off track here. Typically, the escrow fee, escrow is a neutral third party that holds the money, looks after the lender, the buyer, the seller, everybody involved in the transaction. That's usually a fee that's split between the buyer and the seller evenly. Then there's a owner's title policy that protects you as the buyer against any future claims on title. That's an owner's policy that's paid for by the seller. In this number, you also then purchase a title policy as part of your closing costs to insure the loan for the lender. And that's typically a buyer cost. The other big one associated with these would be the transfer tax, which is a tax that you pay on any transaction, which is a percentage of the purchase price. That's typically paid for by the seller. Now, anything I say with this, depending on the deal, those could all be paid by the seller. Those could all be paid for by the buyer, depending on the transaction. We say usual and customary as far as that, and that's usually the norm. And then your second question pertained to, with respect to prepaids and reserves, and you asked, well, but if you choose to pay those yourself, do you have to pay those up front? Depending on the program and the qualifying, I would say certain of those, yes. You could do that, but if you're putting zero down in our scenario, we would require it. The only one that you couldn't pay or you could defer is when you go and buy a house the first year, you have to buy an insurance policy for the whole year. Average insurance policy on this scenario would be about $800. The other components to this might be prepaid interest, which is a function of when your loan closes. And then if you have mortgage insurance, that's not this scenario. Or what's the other piece of that? Taxes. And taxes, it's just a function of when you close relative to when the next bill is due. Answer your question? Okay. Kyle, anything on anybody? Yeah, online? Okay, all right. So anyway, if you can go to page 10. So page 10 refers to the CalCoast Home Rewards Program, and that's administered through our trusted partner, Smart, and they work throughout the state of California. They actually, if you're looking to sell here and buy in other parts of the United States, they can facilitate that as well. But some of the key things, like I said, that 20% commission rebate on a $500,000 purchase would be about $3,000. And if you were to say sell and buy, or you can get up to 25% on both transactions as far as that goes. And so we have this program. It allows you more timely access to the multiple listing service. So Redfin or Zillow, any of those sites are good, but they don't update their data as often as the MLS. Through this site, through our preferred site that you can register for, you can actually go and look at listings by zip code, a variety of options. So we have that ability to access that on the line. 70% of people that purchase homes, this was in a recent realtor study, start their home buying process not with the loan, which is, I would disagree with that process, but they typically go online and shop a market. And one of the values of doing that is you don't have to get in the car and look around, but if you have an idea of where you want to live, you can go and look and see what it costs to buy a house in those areas through the service, and then through the knowledge you've gained from the seminar, you can back into a 43%. What is that going to cost me depending on what I have in the way of a down payment? And we can help you fine tune that a little bit. But typically what happens is when you enroll in our program, John or one of his associates will call you up and just say, hey, how are you doing? Do you have any questions about the program? Are you looking to buy today or tomorrow? And you basically can say, hey, I'm just looking, or I'm buying in the next 3 months. We would be happy to work with you, and he will tell you about all the requirements to get enrolled with the actual buying service. If you're currently working with an agent, this is not a solicitation to cancel that relationship in any way whatsoever. We're just showing you it as a program. Part of this program then is if you're looking at specific areas and you want to get regular notifications on new houses that come for sale, we have a new listing email that you can sign up for that'll keep you up to date on what's going on in your area. And of course, the home savings and additional discounts. The value of working with a real estate agent is tremendous. If you've never bought a house, and most of us will maybe buy one or two, if we're fortunate enough in our lifetimes, there's a lot of components that go into purchasing a house, and working with a knowledgeable, experienced realtor or real estate agent is invaluable, not only to you in showing you homes and pointing out the marketability or the benefits of a particular style of home. It also helps with the transaction. We're very reliant as a lender on the efforts of the realtor to keep the transaction moving forward. So I can't discount the fact that having a strong real estate agent makes a transaction go very smoothly. We've closed several transactions already with John's group and have been very pleased. They've been with us as we have been with them in getting timely transactions completed. You have a question?
Yeah. What's required for registering?
Absolutely nothing. We have a card that you can register. If you want to fill that out, we'll get you registered and we'll send you an email. As I said, we will call you. So when I used to say no salesman will call, we will call just to make sure you're enrolled with the program and if you have any issues with that. And then that gives you complete access. If that's where you end it, that's fine. If you go on from there, you'll have access as long as you want with respect to the program. Any other questions on that? Okay, so that's a tremendous service, and I would recommend those of you here that if you want to enlist in the program, we'll get you signed up and get you access to the program quickly. For those online, we will be sending the same registration form to you so you can apply, and we'll get you signed up as well. lastly, the only other thing I wanted to touch on is on page 12, since we have time. And this, I'm sorry, I'll leave it there for a second. So this is what the site looks like, and that would be on page 11. And basically, if you've been online, you could basically put in a zip code. You could put in a city. The more information you put in, the more specific the search goes. And then once you get into that, you can have a variety of filters. So with that, that would be the main portal for that to get into it. And then if you go to the next page, I want to talk briefly about types of housing and affordability. Now, the most affordable housing in San Diego City proper right now would be a condominium as opposed to a single family residence. But with the condominium comes that added expense of a homeowners association. And one of the things that I would caution you is if you're looking downtown and you're buying a condo and a high-rise condominium, those HOA fees can be as much as $800 a month right now. And when you look at calculating your total debt ratio, a lot of that can be eaten up by an HOA fee. So where our 100% program or in any loan program, if you go and buy a condominium, that $350 average HOA fee really cuts to your buying power. And clearly, if you can buy a single family house, you have your best execution because most of your money is going towards the loan and taxes as opposed to an additional HOA fee. So while the cost may be lower to buy, the monthly expense could actually be higher than a comparably priced single family house because you're not required to pay an HOA fee. The difficulty in San Diego proper is that it's very difficult to find something for $484,000 in a single family home. They're out there, but you've got to look hard. I think I didn't look before this one, but there's quite a few homes. Then you're looking at neighborhood characteristics, age of the home, and that all important and dreaded commute to work. Is it close or far from work as far as that goes? The other type of housing alternative to the condominium that has fewer fees, obviously, you can buy in a neighborhood, an established neighborhood that you pay taxes and insurance, and that's more established. That's a more common type of purchase. There's also communities that have common amenities. I happen to live in a neighborhood where attached to the home ownership, you have tennis courts and a pool. And those are typically known as planned unit developments or PUDs. In these associations, you have a single family home, but you do have an HOA fee that goes to pay for those amenities. And the other type of lending that we do with respect to real estate is we do lend on manufactured homes, but the manufactured home that we will lend on is not a manufactured home that's on a trailer in a mobile home park. And while that may be the most affordable, that's still considered personal property. It's not real estate because you don't own the land. So the type of lending that we'll do on manufactured homes is actually a manufactured home that's been affixed to a permanent foundation on a piece of land that is owned. So that's the other variable associated with that. So those are the key components. We have condominiums, we have single family residents, we have single family residents that are PUDs, and then we have manufactured homes, which are single family homes, just it's the type of construction associated with that. And a manufactured home is assembled off-site, brought to site, and erected, whereas a home is typically traditional built it's stick built on the site. And for whatever reason, the market differentiates between those two. Okay, so if we go to the next step, what I like to recommend is you go online, you look, and you determine what you want to buy. And for my own personal buying experience the first time around, I've bought 2 houses in my lifetime, and maybe one more when I kick all the kids out and move to Arizona or what. I'm not sure. But if you want to decide to buy, why would you buy? Because it's the right time for you. And from a qualifying standpoint, your debts are low, and you can get into a house, a payment that you can afford, and maybe that will stabilize your housing payment from going up. It's also a great investment. So the next thing would be to look and see, what type of housing you're really looking to, what you like, what you dislike. Do you want a yard? Do you want a 3-bedroom? Do you want a 2-bedroom? What is your ideal situation? If you can't buy your dream house, what's the bare minimum that you can get in for, that you want to get in? And again, I'd emphasize getting in and staying in is a great option, and I speak from experience as a 20-year homeowner on that. I guess I'm still on. Is that still working? Okay. So the next step is to secure your financing. One of the difficulties that we have with folks is they determine what they want, and then we tell them what the payment's going to cost. They want that $700,000 house with the pool and the yard and access to the tennis courts, and with their ratios and their down payment, it's more than they want to spend. So there's a little give and take in knowing what you want and then being able to afford it. Either way, whether you enter it from trying to determine the property and back into it through loan qualification, you're going to have to get pre-approved to move to the next step of the transaction. And so most realtors, if they're worth their salt in the industry, will require that you're pre-approved with the lender. And it's to your benefit to get pre-approved, because if you're making an offer, it just makes your offer that much stronger. And what I mean when I say pre-approved, we offer free pre-approvals. It's not a pre-qual. We're actually going to take an application. We're going to verify your income. We're going to verify the assets for the down payment and or closing costs. And then we're going to issue a commitment to lend. You are pre-approved to buy a house of X amount, and then the only variable is the house itself and the transaction. So if you're submitting an offer to a seller that's anxious to sell, and you show up with an offer that's in their range as far as the purchase price, and you let them know you're pre-qualified for that, makes your offer that much stronger. And so one of the things that we do on a regular basis is we get a lot of people pre-approved. The difficulty then is finding the housing. And getting the loan and getting the housing are two separate processes. And depending on the marketplace where you're looking to buy, there may be a lot that are on the market, or there may be a very tight market. They come on and they go off the market very quickly because people are there to snatch them up when they come in. But if you're not pre-approved and you're looking at a 30-day or 45-day or 21-day escrow, as a lot of sellers are trying to get in and get out quickly, if you're not pre-approved, you're not going to get an accepted offer. John, anything else you would add on that? Is that pretty? You're demonstrating to the seller and the seller's agent that you're not messing around. You've done all you can do. Now you're just zeroing in on the home. Did you have a question?
Yeah, I guess if you're pre-approved for X amount, and let's say you find a home that's 10,000 less than what you're pre-approved for, are you able to still use the full pre-approval amount, let's say, and cover that 10,000 for like closing costs?
Okay, great question. The question is, if you get approved for a certain amount, but you buy something for less, say $10,000 less than the pre-approval, unfortunately on a purchase, you're approved, you can't finance the cost into the loan. If you put 20% down and you finance the remaining 80%, that's the terms. If you now want to include the closing costs, you just put less money down, and you basically take a higher loan. Does that make sense? I was anticipating a slightly different question. So the other question is, what if I get approved for a higher amount than what I want to make an offer on? I would recommend that you, if you're working with us, we can alter the pre-approval to the offer so as not to play your hand before you have to. So if you, for example, let's say you're approved for $500,000 and you're bidding on a house for $460,000. Well, depending on the marketplace, let's tell them you're qualified for 460. And then if you need to go up, we would, if there's a counter offer, we would change the pre-approval letter to whatever the offer is. And I think that bodes well. If it's $10,000 difference, that may not give up your leverage as far as buying. But if it's something where you're trying to go low, let's don't go any higher than what the offer is, as far as that goes. And buying and selling, again, do you pay what they're asking for on the property? That's a separate discussion that you have with your agent. And with our agents, they're going to demonstrate to you what has recently sold in the market, what the amenities of the houses that sold in the market place had. Did they have a new kitchen? Does the one you're buying have an old kitchen? So are you paying the price of the house that has the old or the new kitchen when you have an old kitchen? There's a lot of variables that go into it, and that's where working with a real estate professional to establish what you bid on a house. Sometimes there's 4 other people that are making offers, and it becomes what the other person is willing to pay versus you to get the property. So there's a lot of variables. Like I said, securing the loan and knowing what your payment will be versus that's as far as you can go on the transaction. Now you can worry about looking for the property and the whole negotiation. And when you make an offer on a house, does that mean you're stuck to buying it? Well, it's an answer to give you no. Typically, when you buy a property, at a minimum, there's a 17-day contingency. So if you go and make an offer on a property, you have 17 days. And so I just saw one recently where they said 10 days to do all your inspections. So if you buy a property that's maybe has a little bit more deferred maintenance, needs paint, needs other things, you would go and get a whole physical inspection of the property, and you'd have the ability to go back to the seller and say, hey, I want to negotiate down based on certain variables. Now I'm getting into tactics that I want to get in, but when you go and make an offer, it doesn't automatically bind you to buy the property. Other situations that we're seeing a little bit more, not as often, is folks will make an offer, they'll get an accepted offer at a certain purchase price, and when we go and do the appraisal, it doesn't come in for the purchase price, at which time they go back to the seller and say, hey, it doesn't appraise, or the borrower is willing to pay that price. There's a whole new negotiation that goes in. I guess the point that I'm making is if you have your loan terms and approval all squared away, then you're only working on the purchase negotiations. One thing I'll share with you, buying a house, I've bought 2. I've only been in real estate my whole professional career. Buying a house is a very strenuous, emotional tug of war that you go through. Unfortunately, you won't fully understand the process until you've finished. We can talk about all the things you can expect, but the emotions of, well, why did the seller come back and say this? What are we trying to do? There's any number of things that come into play. So working through as much as you can on the front end helps you deal with that on a much more level basis as far as that goes. So. So in the question or the comment pertains to when you have a lot of cash buyers, that's a very difficult thing. I just recently worked with a home buyer that really sold the fact that a family was going in to buy the house. And so in addition to the purchase offer, they put in just a basic a bio on their family and why they like the house. In an effort to maybe get a little leverage over, say, a cash buyer. In a market where you have a seller that wants to get in and get out quickly, that's always going to be a challenge with respect to a cash buyer because they're going to have less requirements. They can close quicker. The only thing I can say is if you're pre-approved, you're that much further down the road. All things being equal, if you can still close in the same amount of time, that becomes something that a good agent can maybe get over. But I don't think there's any substitute or alternative to a straight cash buyer. John.
Typically, just to add, typically a cash buyer is going to ask for a cash discount. So on that 460 house, they might be at 440.
Right.
You're pre-approved at 460. You're able to offer a little more for the house than that cash buyer.
So to John's point, if there's a cash buyer, they're looking to get something in exchange for a cash purchase, less contingency. So the seller may actually be required to sell at a little bit of a discount. Does that make sense to everybody? Yes, ma'am.
You said that households might change the numbers a little so that they don't see what we see approved for. Does the seller see your maximum pre-approval? And then the second is, how long does an pre-qualified last?
Okay.
How long can you reapply before it affects your credit negatively?
Okay, great. 3 questions there, and I'll just say that this will be the last question. I don't want to keep anybody over. So anybody that's streaming online that has to leave, feel free to send a question, and we will get back to all of you. So first question is, I don't work, when you're talking about a pre-approval letter, only you see the pre-approval letter. We're going to send that to you. You can forward that to your agent. So we're working for you. And even if you have an agent involved, we will typically send it to you unless you. So to answer your question, the seller will only see what you give them. Okay? The second thing is on the pre-approval. I'm not going to even mention that word pre-qualification. On a pre-approval, it's as, think of it this way, it's as valid as and stays in place as long as your data and your information doesn't change. The only thing that becomes stale dated, we will typically hold a pre-approval for 90 days. As you get towards 60 or 70 days, if you're still actively looking, we may ask you for updated pay stubs, and then only at the end of 90 days we may rerun credit, which may ding your credit score just a little bit, but not significantly. If you're not looking to buy for a year, you probably don't want to apply for a loan today. If you want to get information on what you think you qualify so that you can apply for a loan in a year, then we can take that in the form of an email question, and we can get you that information, starting with that 40%, give you some basics as far as that goes. So I think that answered your question, right? Is that right? Okay. Well, anyway, I'm going to leave it at that. We've reached our hour. I greatly appreciate those that were following on home or at work on the live stream. And for those that have attended, I will stay after for a while if there's any other questions that you have personally. But I want to thank you. We try and offer this service to educate education program. So thanks for attending.